Today, we may have inflation, but we haven't really seen a downturn in corporate profits, at least yet, much less a weaker dollar. We've seen just the reverse, in fact. Rebecca Patterson of Bridgewater and Sarah Ketterer of Causeway Capital have stayed with us. So, Sarah, let me go to you on the equities question. We had a lot of earnings out this week. It went both ways, but I think sort of overall, earnings came in pretty well so far.
They have, and I think both Rebecca and I have commented on the what's happened in the past isn't necessarily reflective of the future. In other words, there are so many challenges ahead in a persistent inflationary environment for companies in terms of cost increases, not to mention a consumer that's deliberately being reined in, that this just may be a really tough next several quarters of reporting. How tough, hard to say, but unlikely to be buoyant. And that's to the point that we've seen multiple derating. Now we may very well see earnings fall too. And that's typically what happens in market pullbacks. Both multiples and earnings fall. And that, again, is a phenomena that will likely occur globally.
So, Rebecca, you have a little bit of money at Bridgewater that you have to put to work every once in a while. What about the question, particularly of debt versus equity? You mentioned before the question of when stocks are attractive. We had that Bank of America fund managers report coming out saying, look, you're better off right now going into bonds.
We don't see bond as attractive at this point in the U.S., but also in places like Europe. With the Fed still tightening, with the Fed demand for bonds now gone, it's going the other way. Banks were huge buyers of bonds last year. They're gone. We think there's going to be a greater challenge for demand to meet supply there. But there was another great point just made when we were referencing 1975 there, which was this fall in the dollar and this move into gold. And it's so interesting to compare what was happening then versus now. And back then, we saw the dollar fall in part because people thought that inflation expectations were unanchored and high inflation was going to undermine the value of currency. And as you just said, it's the opposite right now. We've seen a strong dollar as the U.S. has looked like the nicest house in a bad neighborhood. What I would say, though, as we think about earnings and equities and bonds and people's portfolios, is that we're in a world that's so different from the last decade when it comes to currency markets. Volatility is picking up. And as we have inflation surprises, monetary policy surprises, and a huge cone of uncertainty, we should expect that FX volatility to continue. And it flows through to companies, I think, two big ways. One, just if the companies themselves are hedging that risk or not. So we are seeing multinationals underperforming more domestic companies by wide margins just year to date. We think that is likely to continue as these kind of relatively wild moves continue in currencies. And then more broadly, if you're thinking about your portfolio, what currency are you denominated in? What currency risk are you taking? And it can make a very big difference to your performance. I mean, just year to date, if you think about if you hedged a foreign currency equity or didn't hedge, it could be the difference in 10 percentage points in performance for those stocks. And we think that's going to continue and possibly escalate. So I would just say, as we think about equities, we think about bonds and earnings, I would also make sure not to ignore currencies as part of that equation for your total return.
So, Sarah, take all that and put it together. I think you're somebody who's really look at a particular kind of value investor. You look for good value in terms of low valuations, buying at the bottom, moving up with it. What's attractive to you right now?
Go where the currencies have been the weakest, where there's potential for a return to some sort of more normal currency valuation. And the euro might be a good place to start. The euro's off about 12% versus the dollar year to date, and maybe 15 over the last 12 months. So yes, it's on sale, and it has been painful having stocks denominated in euro unless they were dollar earners. But this does present an opportunity because likely the Eurozone will go into some sort of pullback as energy becomes scarce, particularly this winter, natural gas in particular. But out of that is the recovery, especially given the amount of spending that the Eurozone has in mind in order to revitalize their economies. And it worked for the U.S. It's likely to work for the Eurozone. So there are stocks that companies now buying back large portions of their outstanding market cap. That's really interesting. If they're that confident in the future and they know a whole lot more about it than we do in terms of their own companies, there are a number of European banks. UniCredit in Italy is one example. Not only are they buying back 14% of their stock, they have a 6% dividend yield. That's like 20% payout yield. That's fantastic on on 40% of tangible book value. You may think that sounds terrifying. Who wants to be in Italy right now? There's political uncertainty. But that's exactly when you want to buy, because the next stage is you get back to 60 or 70% of tangible book and you've doubled your money.
And I guess I would contrast that, you might be seeing great opportunities in specific companies. But when we look at Europe overall, from our perspective, we are still bearish. Now, there might be a timing element, Sarah, between what you're saying and I'm saying, but agreed that they're doing some fiscal stimulus. I think with the potential for them to lose more energy supply in the winter, it will be important to see if the governments take those losses off the companies and onto the government balance sheets, just like we saw the U.S. do for some U.S. companies during COVID. Will Europe do that as well? That would certainly be a positive for European equities if that move happens. In the absence of that, I do think you have to reckon with the ECB tightening in what is an incredibly challenging environment. So the European Central Bank slowing growth even worse than what we're seeing in the United States so far, and very high, multi-decade high inflation. So they're stuck between a rock and a hard place. And you mentioned Italy. Look, Italy tends to go through governments roughly every 18 months, going back to World War II. So this is not that unusual. However, Italy right now desperately needs these fiscal transfers from the European Union. And if this government, which isn't as cohesive today, is unable to pass reforms, the fiscal tap gets turned off. And if the fiscal tap gets turned off while the ECB is tightening, I think European equities are really going to struggle.
So at the risk of my head hurt here, let me at a whole nother level of complexity, China. You talk about somebody who's going through a bit of a rough patch right now in terms of growth, COVID-19, COVID-0 policy and things like that. Are there any attractive potentials actually over there, Sarah?
China is very complicated at the moment, to your point, because it's been a draconian lockdowns. And back to Europe, I mean, so many European multinationals have business in China or do have some sort of trade arrangement, so it's been tough for them. There are all kinds of these supply side shock problems. Central banks don't really do anything about that. They're all about the demand side. So that's one of the reasons why Europe's likely to recover, because they don't need to engage in massive tightening to offset inflation. Good part of that is supply related, and some of it's coming from China. And how long the Chinese government intends to strangle their economy is the big debate, because they can't go too far, because the pact is we rule with an autocratic arm and you have prosperity. If the government takes away prosperity, the autocracy may be in danger. And that's what makes China so fascinating and potentially combustible at the moment.
And just adding to that, I think one of the things we got out of the Politburo meeting this week was we're going to stay focused on infrastructure stimulus in China. We're not going to increase the focus on consumption. And so when we think about how the different levers of Chinese growth flow through to multinational companies, it's important to understand that nuance. If it's infrastructure-led, that's going to have a different spillover effect to other companies around the world, commodity-related companies, companies that are servicing that infrastructure versus the consumer. But to the fragility of China today, if you go to the youth unemployment rate in China, I'm sure you've reported this,
Yes.
It's a big deal. Unemployment almost double what we have in the United States, close to 20%. That's something China can't tolerate. And so I would expect over the coming months, we're going to see more and more steps for them to try to make sure these young adults have jobs, whether they're with the state-owned enterprises, through some of these infrastructure projects, et cetera. But I am concerned that growth in China isn't going to recover that quickly in the second half of the year, which again folds into this bigger global growth picture. Europe's slowing, China's slowing, the US is slowing. How do we see stocks rallying sustainably in that environment?